Hello, everybody. Thank you so much for being here. My name is Jude, and I'm joined by my colleagues Ricky, Dutch, and Weston, and we are going to be presenting a few perspectives on the upstream M&A environment. Just to give you a brief overview, we're going to talk a bit about where we are and how we got here, and then spend a bit of time talking about where we think things are headed. We're going to illustrate some potential M&A scenarios, some risks, and benefits in the short, medium, and long term, and then ultimately our thesis on consolidation as a whole. So first things first, 2023 obviously saw a record amount of M&A volume, sitting right around $192 billion of aggregate deal value. And this was kind of headed by three very large transactions that we wanted to point out because we believe they serve as a sort of bellwether as to where the M&A environment is headed. The first transaction we wanted to point out was the Oxy acquisition of Crown Rock, which we think illustrates the importance that buyers are placing on Tier 1 acreage and the premiums that they will pay to avoid drilling these riskier Tier 2 and 3 wells. Second acquisition we want to point out is Chevron's acquisition of Hess, which we believe underscores the importance of diversification. We think it's a really important transaction for Chevron because it illustrates a sort of 1 + 1 = 3 effect for the company because it allows them to get the geographic benefits of diversification without paying the huge premiums usually associated with entering the market organically. The last transaction we want to point out is Exxon's acquisition of Pioneer, obviously arguably the best shale player in the Permian, and while we believe M&A is going to start radiating out of the Permian. We'll see kind of a diffuse effect there. This transaction shows that Permian will still remain a hotbed for M&A activity.
So what is this really being driven by? Well, there's kind of three main points we want to focus on. One is the idea of CapEx in the industry. We all remember back to 2014 where it was drill, baby, drill, and shareholders were not able to collect returns on their investment. Today, we really do see a change in feel from the industry as a whole and what shareholders demand. Right now, the focus is on a return of capital to shareholders through the form of dividends and share buybacks. In order to sustain these buybacks, they've had to continue to draw down their inventory with reinvestment rates going from 30% in 2022 to 70% in 2023. And as they have started to draw down their Tier 1 acreage in their inventory, they're having to go out and buy companies to acquire more acreage in order to deliver the returns that shareholders seek. Furthermore, we also see that buyers and sellers are both agreeing on these prices. We've seen a lot of price stability in the industry with around $70 to $80 oil for around a year, and then going out about 2 years, the future curve kind of gives a similar outlook. So for us, we see that for buyers, it's accretive to their current production, and it also allows them to continue to deliver strong returns. Furthermore, for these types of companies to diversify and go out and find new wells is A, risky for investors, and B, it might not pay out due to the risk inherent. From sellers, we also see that there is, a lot of these sellers, there's not going to be a big upside for them in the future. So for them, it makes sense to get out now while there's premiums being spent on these types of companies and there's just plenty of M&A activity. And with debt costs, coming down in the future, and then also we start to see these large amounts of share buybacks allowing to fund these share expansions, it just makes sense that the industry is going to keep going this way. So continuing that point, we kind of see that in the futures curve, 2 years out from today, oil prices are expected to be around $70 a barrel looking at the futures curve. Furthermore, we see that the stock ratio for the Chevron Hess acquisition, as well as the Exxon and Pioneer acquisition, have stayed relatively stable, trading at just about a 4% and a 6% discount per share compared to what was announced a few months prior. What this really shows is that both shareholders think that A, the deal is going to close, and despite the regulatory risks that are present from the current administration, we don't think they are as strong as people seem to think. Furthermore, this continued price floor of around $70 per barrel further amounts to the stability that we've seen in the industry and the returns that want to be generated.
Thanks, Dutch. So speaking of future M&A, we wanted to give a few scenarios. Like Jude mentioned, the Permian will still be a hotbed for M&A, but we think also it will radiate outwards. So in the Permian, we still have Endeavor Energy Resources, or Endeavor Energy LP, which has a large position in the Midland Basin and is expected to probably draw around $25 to $30 billion, and there are only a few potential acquirers in that space, and that would be the likes of Exxon, Chevron, and Conoco. And although a couple of those names, Chevron and Exxon, have done huge deals recently, they were all-stock deals, so they have potential to tap into their cash reserves and still make a large acquisition if they decide to expand their Permian position even more in the case of Exxon. And then outside of the Permian, some of the Eagle Ford names, Devon and EOG, could be looking to expand their acreage given that they're diversified E&Ps. I just threw names there, Silverbow and Magnolia, but there's also some private players that are being sold by some PE firms in the Eagle Ford as well. Out in the Bakken, Grayson Mel Energy, an NCAP-backed operator, has reported to be up for sale without fetch around $5 billion. And the merger that makes the most sense would be with Chord Energy, who already has a big position in the Bakken, and that would be more of a merger of equals. They're sitting around a $6 billion enterprise value. And then in the DJ, Civitas has made known after their Vencer and Taprock and Hibernia deals, they're looking to divest some of their non-core assets in the DJ. And so some of the biggest players there are Chevron and Oxy, so there's some names we threw out there, but they are for sure looking to get rid of some of those non-core assets for about $300 million. And then in the Uinta, XLC Resources, another NCAP-backed company that could potentially go up for sale later this year. And some names that I throw in there that are already in the northern Utah are Aventiv and EOG. And overall, the theme we wanted to drive home here is that consolidation will continue, whether it's inside the Permian or outside. There's still a lot of acreage for these operators to acquire, and it's required, honestly, in our opinion, to drive, as we mentioned, shareholder returns and production for these companies. And so on some of the selected immediate benefits or short-term benefits of consolidation, as we mentioned, we believe it benefits shareholders as they've demanded over the past few years, especially after COVID, that E&Ps shift from the drilling that they've done in the past to focus on dividends and share buybacks, and we believe that is possible through consolidation, as some of the points Dutch mentioned earlier. A lot of the rationale, Vicky Hullub, the CEO of Oxy, mentioned that there are two main reasons why they acquired Crown Rock, and that was for free cash flow accretion and to return capital back to shareholders, as well as just to get access to Tier 1 and Tier 2 inventory in the Permian, where most of the drilling is happening right now. And then also in terms of U.S. energy supply, we believe a more consolidated entity are able to handle price shocks a lot better. They have lower break-even, so lower cost per barrel, and that helps the operator be more efficient. We believe that as a whole, that's good, and it's a benefit for the U.S. energy supply. And we don't think the U.S. will step down from being the top producer of oil. We believe that's going to remain despite OPEC Plus and their cuts, and that will be especially true if this consolidation trend continues, which we think it will. And I'll pass it on to Weston and talk more about the benefits.
Thanks, Ricky. So in terms of the longer-term benefits, you really see these occurring with three main groups. One, the industry as a whole, and that's primarily going to be seen through efficiency gains in production with a lot of the majors and larger companies taking control of that Tier 1 and 2 inventory that Ricky mentioned. They're going to be able to maximize the productivity of that acreage. Additionally, on the consumer side, we're as Ricky mentioned, we see this being a pretty substantial improvement for U.S. energy security, which we believe benefits the consumer and the broader U.S. economy. And then in terms of the environment, we see positives as well, with some of these larger, more highly scrutinized companies taking control of a larger share of production. They'll be able to implement a lot of the ESG initiatives, as well as devote CapEx toward, some of these other projects like the carbon capture with Exxon's Denbury acquisition. Awesome. And then in terms of risk analysis, the main risk we see with continued consolidation exists within the regulatory framework. We haven't seen this as much in the oil and gas space, but there certainly has been some questions as to the possibilities of future M&A after the Spirit JetBlue merger was blocked by the administration a few weeks ago. We don't believe this is as much of an issue in the oil and gas space, but definitely something to keep in mind. Beyond that, things like increased public scrutiny, shareholder dilution, deterrence of new entrants, and some potential environmental risks also exist. Next. So in general, we are very supportive of U.S. upstream companies push for consolidation. We believe it's positive for the industry, for American energy security, for environmental factors, and most importantly, for shareholders in terms of return to capital. Thank you.
Alrighty, so we're going to go ahead and get started. We're talking about E&P mergers and acquisitions again and the future of it. I'm Carson Hallbauer. I've got Paige Schindler with me and Carson Meckler. And we also wanted to give an honorable mention to Alex Posey, who came yesterday to make this presentation, ended up getting sick halfway through. So Carson Meckler ended up being his substitute. So MVP goes to him for pulling through last minute. Next.
So just starting out with our presentation agenda, we're going to begin by giving an E&P mergers and acquisitions overview, moving on to stakeholder impacts, domestic supply growth, consumer impact, environmental transition, risks and opportunities, and then we're going to use all of this information we've talked about to provide future consolidation candidate recommendations.
So within the past 5 years, we've seen a lot of mega mergers and acquisitions within our industry. Some of the key ones we want to point out here is the BP and BHP, Chevron and Noble Energy, ExxonMobil and Pioneer, Chevron and Hess, Chesapeake and Southwestern, in the Oxy and Crown Rock acquisition. This chart to the right, it shows the M&As in the upstream industry between 2001 and 2020. And it's color coordinated by which region. And as you can see that the most prominent M&As have been happening in our North American region.
All right, and so then I'm going to start talking about the impact on shareholders here, and we'll start with this graph. You can see that most of the deals that are made that are worth more than $1 billion actually end up losing value for the shareholders. The upper quartile actually does provide a lot of value, but a majority of these mergers are losing value for the shareholders. And the problem is that when these companies are coming together, they're worried about the general and administrative costs, when really they need to be focusing on their synergies and how they can work together and create new value from the merger. And in fact, when these companies come together, if they announce that they have specific synergy goals, it increases total returns to shareholders by 7%. And this is just because these executives now have a very specific goal to work towards, and that increases productivity, and then that comes back to the shareholders.
So answering the question, does merging spur or inhibit domestic supply growth? So usually with these M&As, you are going to expect to see an increase in projects that are taking place overseas in different countries. But within the past few years, with the pandemic as well as the Russia-Ukraine conflict, there has been a huge inconsistency in oil and gas prices. And along with market speculation and other geopolitical interferences, we are expecting that these will actually influence companies to desire consolidation and prioritize domestic supply growth. And this implies and shows that E&P companies are actually heavily impacted by market versatility. And this is why we think that through merging and acquiring other companies, they can actually remain more secure within the industry. And looking at the chart on the right, you can see the monthly U.S. crude oil production by region. And looking into 2024, we are expecting to see that this is going to increase. And we think that with these mergers and acquisitions, we can see that will actually further increase going into the future. And I think a good region to highlight is the Permian, because that has been a very active, sought-out region for M&As, especially with Exxon and Pioneer.
Asking the question, how will this impact the consumers? Looking at the M&As in the United States, this can bring the oil prices down for the consumer, and also it'll decrease the amount of control OPEC has on the markets throughout the world. With the Pioneer and Exxon M&A in the Permian, it's said to boost Exxon's productions almost double to 1.3 million barrels of oil. And just recapping that, these M&As, it'll have the oil prices down for consumers, and it also will strengthen the energy security in the United States.
Now talking about the energy transition, I'll talk about how the energy transition is actually impacting these decisions and these mergers and acquisitions, and then I'll talk about how they impact the energy transition. So first thing I want to talk about is how a lot of what's happening with these mergers and acquisitions is there's a big acknowledgement that the energy transition is coming up, and these companies are wanting to make short-term shale investments because this doesn't take as long, and they're just a lot more short-term than other investments. So you can see here that some of the bigger deals that happened were Chevron Hess and the ExxonMobil Pioneer, and Hess and Pioneer both have significant shale assets, and that's the reason they were taking it up, because these oil companies are getting ready for the energy transition. And then I'm also going to talk about transition goals. Basically, when companies are merging, the industry leaders and the industry laggards typically have very different priorities in terms of emissions and transparency, and the industry laggards don't usually prioritize this. So when there's a merger, the smaller company usually is kind of holding down the upper company from their ESG goals. And we saw 155 of these deals have moved assets away from net zero aligned companies. 298 have transferred assets from companies with flaring commitments to those without. 211 have pushed assets away from companies with methane goals to companies without explicit methane goals, and 150 have shifted assets from OGMP members to non-members. So we're seeing a movement away from our transition goals.
So looking at risks and opportunities of M&As, starting with opportunities, E&P companies will have the ability to expand their market share within the basins that they are currently operating in, and will gain access to share in new regions, and this can contribute to the overall optimization of resources and particular basins, increasing the oil and gas production within those areas. And we also believe that the merging of net zero initiatives as well as ESG scores could catalyze the energy industry's transition towards sustainability. Looking at risks, the negative impacts on human capital due to changes in company culture can impede on overall work performance and could hinder the value of the overall consolidation. And I know from our experience, some of our friends back home are concerned about the future potential of their careers in the industry due to these M&As. And then with inconsistencies in the oil and gas market, there is always a risk that mergers are going to fall through, and without proper planning, I mean, we could see that maybe there's less in the future. And a good example of this was Halliburton and Baker Hughes in 2014 when they attempted to merge during the oil market crash.
When looking at who should consolidate, we're really just looking at companies seeking to diverse their assets. Shareholders can benefit a lot when a company adopts new assets into their portfolio. The differentiated value, it can defend the company from market validity. Companies with larger or smaller shale assets, like Paige was saying before, these companies are really looking into those short-term shale investments, especially with the energy transition coming up. A lot of companies aren't looking to lock in those more long-term operations. And this also is very apparent when the company that is being acquired already has a large dominance in their said basin. And also looking at companies with high or low ESG scores, just by merging, it can improve the company's overall ESG scores.
Okay, so based on everything we've talked about, we gave some recommendations on who we could expect to potentially buy in the future. Starting with BP, they are currently looking towards expanding their shale assets in the Haynesville and Eagle Ford basins, and they are targeting right now short-term joint ventures, although the value and terms of their agreements could push them to long-term acquisitions. And then looking at Devon Energy, they have been in contact with Marathon and Crown Rock because of their shale assets, and both deals would be expected to be worth over $10 billion and also focus on Permian assets. Again, hitting home that a lot of these buyers are looking at medium to small companies who are heavy in these shale assets just because they are short term, but they are also profitable.
And then some of the companies who might be selling, again, there's plenty of them, and we just wanted to hone in on a couple. The first one we mentioned is EOG Resources. We mentioned them because they have a large shale assets and they're one of the top producers in the Permian Basin, which is really useful because there's a lot more leniency on regulations and some benefits for midstream purposes. Exxon has actually already considered acquiring EOG because of this, and that's also because of their high productivity and their high liquid production, other things like CapEx benefits and synergies like I talked about before. And we've also got National Fuel Gas Company, which I wanted to mention just because they have the most prominent plays in the Marcellus and Utica shales, which are currently the most progressive unconventional gas shales in the U.S. And again, like Paige said, it's all about shale and these short-term investments, and that's why we picked these companies to focus on. And that's our presentation. Thanks for listening.
Good morning, everybody, and thank you for listening. We are excited to share our perspectives on upstream oil and gas consolidation. My name is Caden Light.
I'm Abby Gridley.
I'm Ashley Sokol.
And I'm Cole Readers.
All right, so today we're going to talk to you about the impacts that upstream consolidation has on all of the people involved in the business. So this means shareholders, stakeholders, energy consumers, and then the impacts that it has on the processes like the energy transition and overall domestic supply growth. Then we're going to tell you a little bit about some logical U.S. E&P consolidation combinations that we have come up with and why we think that these are logical for the future, and then some other investments in non-upstream business that we think may be good for the future and that have been going on already. And then we are just going to wrap it up with everything we've talked about and our view on upstream consolidation.
Okay, so to start it off this morning, we're going to talk about the shareholders and the stockholders and the pros and cons of these upstream consolidations on them. So to the hypothesis about the efficient market is that M&A should be profitable for shareholders, but in reality, after 5 years, most acquiring firm shareholders have lost about 10% of their market value. So this, as we all know, with acquiring a company, it can create value, employment levels, have some tax revenue benefits, and community investments. But because of the stocks, it can actually dissolve some of their shares and powers. So a lot of the shareholders and stakeholders lose their voting power, and it changes their payout schedule as well.
So we analyzed the potential benefits to energy consumers specifically through the lens of the Exxon Pioneer and Chevron Hess acquisitions. And although it's really hard to identify a deliberate impact to consumers, we do believe that these acquisitions would lead to stable and competitive energy prices. Both companies are focused on maintaining and acquiring high-quality oil assets and optimizing their production as well as their operational cost. And this translates well to stable and potentially competitive energy prices for those consumers. And the coming together of these two companies eventually leads to technological advancements and efficiency gains. They can leverage those technological capabilities for the purposes of exploration and production processes, and that increased efficiency that comes out of that in operations can lead to cost savings, and that potentially influences consumer energy prices positively. Both Exxon and Chevron are some of the highest rated in sustainability, and that commitment to sustainability absolutely resonates with some of these environmentally conscious consumers and influences their energy choices. And lastly, these acquisitions would lead to long-term cash flow stability, and that stability in cash flow provides a foundation for long-term planning and investment in infrastructure, which leads to a more reliable energy supply. And next, we identified the risk to energy consumers and what we thought were the top three. First is debt-funded acquisitions. A company purchasing another company with a heavy reliance on debt runs the possibility of straining their balance sheets, and those financial challenges that might come after that impact investment in infrastructure and potentially affect the reliability of the energy services that they're supposed to provide. Another one we looked into was regional market dynamics and the impact on local competition and pricing dynamics. This might have the potential for higher energy prices in specific regions, and this would occur if one company had a majority ownership in a particular basin. And lastly, when another company acquires another one, they might have different goals, different strategies, and different company cultures, and those challenges, that might lead to integration challenges in which those operational disruptions might affect the reliability of energy supply and cause short-term fluctuations in prices.
When it comes to the impact that upstream consolidation has on the energy transition, we can see that it is crucial for this energy transition to make way. Companies, especially the large integrated oil and gas companies, are looking to decarbonize, diversify, and divest right now. And we have already seen so many companies looking to decarbonize in ways of investing in so many renewable projects. We see large oil and gas companies investing in solar farms, wind projects, and we especially see this in ExxonMobil as they are trying to become the world's largest lithium producer by acquiring mineral assets in Arkansas and creating an expert team in order to mine these in an environmentally friendly way. Now, companies are doing this with a lot of incentive from the government, especially with a commitment to get to net zero emissions by 2050. This isn't only internal, but external. As a country, we want to get to this cut of emissions, and to do this, companies are looking to decarbonize, invest in more renewable assets, and also get the incentive of carbon tax and governmental funding for these projects. The best thing about this is that these large oil and gas companies that have the resources and experience are able to give their assets and their companies resources to these smaller companies in order for the renewable projects to succeed and to give more experience and a wider customer base for these companies. This is a very positive thing for the energy transition and upstream consolidation as a whole, not only for the smaller companies, but also for the larger oil and gas companies looking to make way in their goals for the energy transition. But it is important to acknowledge some of the challenges that we may face when moving forward. And one of these things is the upstream consolidation between just oil and gas companies. If we're only focused in the oil and gas sector, this may lead to more of those renewable companies and those renewable projects getting pushed down and on the back burner. And then another concern is just greenwashing. Any companies that are looking to acquire other companies just to make green goals, this could just be greenwashing for the public eye and for any regulatory issues. However, with the large players that are in all of the mergers and acquisitions right now and the upstream consolidation moving forward, we don't see this as an issue, and we know that these companies are going to do this reliably and correctly.
Bridging off of what Abby just mentioned, we jumped into energy transition related opportunities, and more particularly, we looked at a company that we haven't heard a lot about in the headlines as of recent, and that company is Shell. We believe that they are a perfect example of a company using a larger balance sheet to buy non-upstream businesses. A statement from Shell says that the world is changing, and as it does, Shell is changing too. We aim to make electricity a significant business. This means being involved at almost every stage of the power supply system, from generating electricity to buying and selling it to supplying it directly to consumers. And through this statement, as well as the investments we've seen Shell make, we do not see Shell remaining a completely status quo company as we have seen in years past. And now they are beginning to jump into prioritizing electricity over just hydrocarbons. And we know this because they just made a recent investment of $200 million into a company in Great Britain called First Utility, who has a customer base of 875,000 people, and they are now supplying energy to those 875,000 people. They also did an all-cash transaction of Volta Incorporated at $169 million, and they now have ownership of one of the biggest EV charging networks in the United States. In addition to that, Shell has also made investments into sustainable fuel as well as hydrogen. And because of all of this information, we do see this company coming into the United States and continuing on their path of purchasing utility companies.
So to bridge off of what Caden says about companies acquiring with a large balance sheet, one of our predictions that we think could happen, which is a logical US EMP combination, would be ConocoPhillips buying EOG Resources assets in the Eagleford. Because of Conoco's Phillips predicted capex for 2023 to be 10.8 billion to 11.2 billion, they have the right capex to take the Eagleford assets off of EOG Resources' hands.
Can you go back one slide? Thank you. And as Ashley was saying, Conoco has a lot of free cash flow right now, so they'll be looking to acquire more acreage, especially in the Eagleford, because right now they're not one of the dominant forces in the Eagleford, and EOG has the amount of acreage to make them one of the dominant forces. We looked into ConocoPhillips just acquiring EOG straight up, but that didn't make sense because EOG's way too big of a company, so we had to think of it more strategically. What would Conoco like to do? So looking at the 570,000 acres that EOG had in the Eagleford, the reason EOG would be willing to part ways with that, in our opinion, was because one of their competitors in the area with Chesapeake just sold all of their Eagleford assets to Silverbow for about $700 million. And the reason we feel like EOG might make a similar move is because they're going to follow suit with their competitors, and they're going to think that their competitor knows something about the area and want to move out as well. And we estimate that Conoco would have to pay about $9.5 billion for the 570,000 acres from EOG. And we believe that EOG will see this as an opportunity to continue to be a dominant force in the Permian Basin, and they could use that free cash flow to purchase more assets within the Permian, where they're a big producer. But with all these mergers and acquisitions in mind, it raises the question of the supply issue. Will the supply of oil in the United States continue to go up? Right now, the United States has the largest proven oil reserves out of any country in the entire world. And with these mergers and acquisitions, we just believe that the proven oil reserves are going to continue staying high and might even go higher. The reason we say that is because these larger companies are acquiring these smaller companies who have assets, and they don't have the funds to go out and do discovery or drill deeper exploratory wells on their lands. And these larger companies have the capital to do so. So we believe that they can find even deeper sources of oil, and they can go out there and develop more of the lands. These larger companies are a lot more efficient as well than these smaller companies they're acquiring. So by acquiring these smaller companies, they're getting access to the acreage, which they're able to develop a lot faster and more efficiently, which is ultimately just putting more oil in the market, raising the supply. These larger companies also have a lot more midstream leverage. These midstream companies are more likely to deal with the larger companies because they're getting more oil from them, and they're supplying a lot more business to these midstream companies. So they have more leverage to negotiate favorable terms, and in doing so, making it cheaper for these larger companies, and then increasing the supply because more oil will see the market. But we also looked a little bit beyond just the oil and gas industry with the supply. We believe that the supply of energy and electricity as a whole will go up because these oil and gas companies aren't just merging and acquiring with other oil and gas companies. A lot of them, like Abby mentioned, Exxon is moving into solar, lithium, a lot of other fields. So with them moving into other fields, they're expanding the energy market as a whole, and they're diversifying energy production as a whole.
After looking at the research and analyzing the costs and benefits of upstream consolidation, we can see that it is definitely going to be a positive, not only for producers and consumers, but also for energy, the energy transition, as well as domestic supply. Because of this, the energy industry is growing, and we do believe that there will be more people to enter the energy industry workforce, which is really exciting. So we're looking forward to seeing the future of upstream consolidation, and we know that it is going to be a positive thing for this industry. Thank you.
All right, hi everybody. Ooh, hi everybody. So today we're going to be talking about looking at M&A through the lens of building a future for energy transition. My name is April. I'm here today with Kevin, David, and Steph. And so we're going to go ahead and get started by talking about what the assignment that was given to us was. We're going to go through our recommendation, which, just a heads up, we're going to be talking about this through the lens of a specific merger as well, and also that energy transition going forward. And then we'll talk about generating value for shareholders, consumers, risks and opportunities, and then we're going to propose a merger that we think takes advantage of a lot of what we're going to recommend here. And then we'll do a little bit of a summary at the end. So, the E&P market, and specifically M&A, has been booming, but there are some downstream effects of each of these. So we're going to talk about this through the lens of stakeholders and how we've seen consumers of oil and gas impacted by these essentially decreases in the number of players in the field. Regulatory issues come in there as well. And then we're going to talk about whether or not the U.S. is right for consolidating, which was the key question of today. And we're going to go ahead and say yes. We're going to say yes, both in the short term, because of the value add for potential consumers and stakeholders, and also in the long term in terms of energy transition. And then we'll also talk more about why that is. We're going to get into specifically stakeholder analysis, and then we're going to talk about ConocoPhillips, the purchase, why ConocoPhillips should purchase Coterra. And that's going to be a primary recommendation that we make here. So, one of the things that we looked at when we took a step back and looked at this on a larger scale is what that energy transition looks like over the next several decades. And while there's still a large amount of supply of oil and gas yet to be explored and activated, we're also looking at things in terms of kind of protecting an insurance policy for regulatory changes, possibility of decreased findings of additional reserves going forward, and opportunities to go ahead and facilitate diversification into a variety of energy spaces. So talking in 2020, we're going to be looking at, well, we've already seen that profits have come back up after COVID. We saw in COVID there was a difficult time in terms of the prices for oil and gas through that time. In the 20s and 2030s going forward, we expect that there's going to be a push towards carbon neutral, carbon capture projects, and technologies that are developed there we think are going to be a strong place for mergers and acquisitions to focus on building synergies for. And then going forward into the 2050s, next slide, thank you. Going into the 2050s, this is where we're going to start making that transition into that more long-term plan of getting into a more energy diversified space and eventually into a heavy renewable energy spot. And so in the 2050s, we're going to be talking about major oil players focusing on building essentially a moat. So building up their balance sheets to be able to support projects for that more long-term investment. And specifically investing in technologies as the reserves deplete again as an insurance policy for that possibility. And then finally finishing up in investments bearing fruit as renewable energy becomes more and more popular, or government regulation kind of pushes the industry in that more renewable direction. And so now I'm going to pass this on to my friend.
Howdy. So one of the issues we need to address in the short term is talking about labor and the supply, and we think these guys are really tied together and they can both be addressed through mergers. Right now it's projected that going through 2025 there's nearly 2 million skilled positions that need to be filled, and a lot of them are out there on the rigs. Right now we're seeing a lot of rigs that are seeing downtime, they're getting sold off by private equity because they're just not running as much as we need it because we don't have the labor. So we're hoping that through these synergies, through the mergers, we can allocate labor a little bit better, we can reinvest into acquiring labor for all of these skilled positions, and we can increase the efficiency, the uptime, and the production in a way that will increase domestic supply. So all of that comes together into building that moat, protecting the castle of our sectors, of our firms. We've seen that the top quartile of M&As return 60% of the value. Got a graph for that later. And the ones that we've seen that are successful are ones that don't focus as much on the G&A savings, but more on actually generating additional value through operational synergies. So that's our big focus when we're talking about M&A targets, is we're looking for operational synergies so we can generate value and not just cut excess. So that's what we're trying to build. That's how we're trying to build up the balance sheet, is by adding more. And then we want to leverage that balance sheet. We want to leverage that moat so that in the future we can start to do all of the things that we know need to eventually happen in the energy space, going towards carbon neutral, going towards renewables. We want to build up now so that we can invest into that and make that transition more safely in the future. So that's our goal, making that advantage, making that transition sustainable and safe for the firms.
So to talk a little bit more about recent merger and acquisitions and the issues that they've dealt with, we believe a smoother path forward exists. Some of the recent issues that have been dealt with are cash flow volatility due to demand uncertainty, and the post-M&A deal flow process there. We would expect diversification across the value chain to stabilize these cash flows against price shocks, such as we experienced in 2020. The depressed valuation in equity markets has been good for M&A transactions in the recent past, and it seems to be going in the alternate direction today. So what we're really looking for in a slightly less depressed equities market is additive value through those operational synergies, as we were talking about, with quick implementation timelines. We want to realize those cash flows almost immediately if we can. And then few firms have investment-grade bond ratings because this space is generally highly levered. And we see there's evidence, substantial evidence, of rating increase after mergers, and opportunities that we can pursue long-term LNG contracts will continue to increase that. So let's talk about a tale of two mergers and the importance of realizing those operational synergies and financial rewards for E&P mergers. So a successful merger, we look at the Devon and WPX merger. It was all stock, relatively low premium, and they had a path forward. They designed a path forward to realize operational synergies. They saw what that future looked like. This allowed the 2-year beta to fall from 1.26 to about 1.1, which is a substantial decrease in risk. And the WPX bond rating was actually upgraded the next day to BB+. And the bond yield went down from 6% to 4%, which allows the company to raise capital much more efficiently and more effectively with lower payouts. Always a win. A less accretive merger that we wanted to look at was the Occidental and Anadarko merger of 2019. The material issue with this merger was the premium that was paid was quite substantial, and it was very cash heavy. So it depleted the cash reserves of Occidental. It increased the debt of both of the merged company because of Occidental incurring Anadarko's debt, which again, in the event of a price shock such as occurred in 2020, absolutely, as you can see, crushed the stock price. The balance sheet is highly sensitive to fluctuations in commodity pricing, and that was the material reason for that stock price decrease. So opportunities to create shareholder value are abundant and often missed, as we see in that merger. The improved downstream effects of shared facilities and supply chains, the improved upstream leverage and field technology to identify drill sites, increase uptime, and improve labor, all are the rationale behind why 25% of the mergers create 60% of the value, and 50% are value dilutive. You want to make sure that you're identifying these operational synergies and then going forward and actually realizing them. But the biggest indicator of realizing these operational synergies is actually pre-merger identification and making sure that you have a plan forward to realize these operational synergies. Now I'm going to pass it on.
So one of the things we wanted to look at was the regulatory risk, starting with how the FTC looks at certain mergers and acquisitions. And part of the reason that they do that is they don't want the market to become too heavily consolidated into just a few major players, because at the end of the day that would hurt consumers. So they're trying to protect consumers downstream. They do that in part because in the US, the market is only worth about $605 billion in total market cap, when other industries have much larger, and they kind of overlook some of the other transactions that happen. But we believe that if this deal is structured properly and it's the right target, then the FTC will more or less look the other way. So while E&P is in a buyer's market, we know that there's going to be risks. I'll point out a couple of them. As I just mentioned, in terms of consolidation with the FTC, You'll have the regulatory risks. Consolidation could end up in just a few major hands. That can be difficult to deal with in terms of regulatory pushback. With any acquisition, any merger, you're going to have culture fit issues, and you're going to take away bargaining power from the customers. The opportunities, though, as some of my colleagues have mentioned, there is value to be obtained. 25% of deals do yield 60% of the value, so it's really key on picking the right target and structuring the deal properly. If you focus on operational synergies and you get to build your balance sheet and cash flows, then there's opportunities to develop technology that you already have in place and deploy that further, and then build it, grow your industry further. So we decided to take a look at a proposed merger, and what we did, we took it from the eyes of who we think is the next major to make a deal, and that's ConocoPhillips. So what we did is we took the companies from the case, and we also took a look at a private company, Hillcorp, and we thought that how would we go about this if we were the bankers or we were the companies looking at the acquisition? So we looked at geographic footprint, potential synergies, brand value add, risk profile, and the financial viability. And we bucketed those 5 categories and went through a little brief analysis in our 5 hours in terms of who we would want to acquire. And we picked Coterra Energy. It allows ConocoPhillips to expand in both the Permian Basin and in Marcellus Shale, so they can really expand their geographic footprint. We've talked at length about operational synergies, but we've identified those and think that that can create shareholder value and consumer value at the same time. And it carries a much lower risk profile and financial viability level because according to EBITDA multiples, it will only be a transaction of about $17 billion. Whereas the others on our list here, much more expensive and would bring in the risk of regulatory issues. So I've talked about some of this on the chart, but we'll just run through it quickly. So from a company standpoint, ConocoPhillips gets to solidify their position, and everything that we've talked about is about building that moat. So we want ConocoPhillips to be the next major player in terms of building balance sheet, protecting themselves, while also delivering short-term value because they'll immediately add 10% to their top-line revenues. From a shareholder point of view, if the company is focusing on operational synergies, then they'll be able to deliver value. And we believe that the deal can be structured that way, plus with some really financy terms. If they do an all-stock deal, there's a ton of net operating losses that can be carried forward, and that's straight shareholder value right to their pockets. And then finally, for the consumers, expanding technologies and giving greater access to these resources, while there's still enough players in the market, they'll reap the benefits of that as well. And then for the conclusion?
Yeah, so to wrap things up, we think the mergers are a good idea if you choose right targets. So it all comes down to making sure that the valuations are on point, making sure that we're focusing on operational synergies. And one of the great examples of that is deploying technologies that one company might have across the entire value chain after it merges. So we think this can help to build up the moat, build up the balance sheets so that in the long run, we can have a smoother transition towards carbon zero, towards renewables, and whatever comes next. Thank you. Thanks. Sir.
All right, how are y'all doing? My name's Jordan. I'm here with my friends and colleagues, Pratik, Tarek, and Ahmed, and we're excited to present to y'all today. So how our presentation is going to be structured, first we're going to talk about the impact on shareholders. We're going to argue our point that the trend must go on, the domestic supply issues, the impact on consumers. The energy transition has also some risks and opportunities.
So first of all, we analyze what is the impact on stakeholders of the current consolidation that are going on. So for this, we did some analysis. We have taken down deals from very low range of $1 billion to the higher range of like $60 billion. And we have analyzed what impact it will create. So first of all, we understood what market will react. So we have analyzed the stock prices and dividends. So as you can see in the graph that we have seen the stock prices of 1 week before the acquisition date, 1 week after, and 1 month after. And we have realized that acquiring company in short term is not gaining much in the stock market. But all of these deals are all equity deals. So when the cost synergies and when the operational efficiency will be realized, then in long run, these companies will gain the market share and the prices. And also we did analysis for the acquired company, and as you can see that share price is almost the same or it is increasing in a period of 1 month and trend is going on. Later we see what are the cost reductions and we have analyzed the cost synergies, and we came to know that there are cost synergies starting from like $40 million to the scale of $2 billion. And when we can see that all these operational synergies and there are operational productivity that is enhancing, to that the cost of capital that we are borrowing from the market can be decreased. For example, Government of America is giving the target to all the banks for sustainability loans. And when we are saving money on this front, that money can be diverted and the cost of capital will be very less. One example is Nextra Energy got $1 billion loan from Bank of America, which is on much less interest. So these are the things which will create value for the shareholders.
Well, thank you very much, Prateek. I mean, as we have discussed on the impact on the shareholders, very important for us to understand either this trend will continue and how this trend will impact the overall industry. So for that matter, I mean, we went back 20 years and we just gathered the data for the past 20 years and we figured it out, like the reason being like why these mergers are taking place, and each company is acquiring another company. There's a reason behind it, and that reason is like most people are going for more reserves, some people are going for different geographical locations, and the end purpose is that they want to achieve the cost efficiency. Some people have strategic alliances, and also some people are going for a high return drilling locations. So we kind of did our analysis, and on the basis of that, we kind of created like a few combos where we felt like there is a possibility where a small cap company like Ring Energy, they have a pretty high LOE, and also they have a very high debt on their book. So a company like Exxon can easily acquire a company like this. And also, there are two more options for Conoco, since they are one of the companies that they are looking and seeking for more reserves on the Permian side. So these two companies, Matador and Diamondback, they have a very low LOE, and I mean they can get it at a decent price to increase their reserves and also financial strength. Also, I mean, it's very important for us to understand like how these mergers will impact the domestic supply and also on the international front. Naturally, in the domestic market, these mergers will have a little bit of a lackluster impact, and companies will kind of dry down for a bit. But on the international front, there's a lot of competition coming up. Companies like Aramco, companies like ADNOC. Aramco recently bought a gas company, Mid-Ocean in Australia. ADNOC recently bought a very big reserve with SOCAR in Azerbaijan. So these companies are expanding. But overall, what we believe that US market, this is a good time to consolidate. And from here, 5 years down the line, they will have enough assets and their supply will grow after that. I'd like Tariq to continue.
Thank you, Ahmed. Another big player in the M&A space is the impact on consumers, and we looked into that. There's a lot of drivers that affect the M&A space, especially in the energy side. We looked at the decrease in the capital expenditure, the dividend increase, and the expansion of the territories in the two big recent acquisitions in 2023 between Exxon Pioneer and Chevron Hess. That could also, like the prices for the consumers could also be contributed to the slowdown in production in the third quarter of 2023, which is expected by analysts to increase back in inventories of production to increase in the first quarter of 2024. M&A experts agree that just the consumer side, or the impact on consumer, is affected or divided into four quadrants, just based on the customer rating of the buyer and the seller companies. And the recent acquisitions of Exxon Pioneer, Chevron Hess would fall into the moderate side of risk because of the high rating for customers on both sides. But that doesn't always work out. It just depends on the synergies of the consumers. We saw the Santos Woodside, the recent M&A. did not work out, even though they did fall into the moderate risk. Santos is twice the size of Woodside, but the synergies did not fall there for those two companies. And now, Jordan.
Thanks, Stark. So now talking about what this means with the energy transition. So these consolidation efforts, really we're seeing some improved cash levels, improvements to working capital, and really they're diversifying their portfolio, which is setting themselves up for success in the future. We've also seen some strategic acquisitions within the low carbon space, specifically targeting quality of assets, experience, and infrastructure that aligns with their current business units. And an example of this that we've seen with Denbury and Exxon. And really, I think it's critical that we keep the transition in mind. Current investors and the general public are holding companies accountable right now. They want to see movement towards their goal of net zero. And so really also this consolidation, like I mentioned before, is setting you up for success in changing in regulations, right? Because that is something that seems like it's going to be inevitable and is something that needs to be on our watch list. And lastly, we put a piece of talent in there. The younger generation cares about the climate change and the energy transition more than maybe the past haven't. And so attracting and retaining top talent is key in this matter. Let's just talk about a couple risks and opportunities. Slowing down the innovation during the consolidation is one thing to watch out for. Slowing the transition to cleaner energy, there's both positives and negatives to it. Really, whenever you're making these E&P acquisitions, you need to make sure that you're not losing sight of the end goal. And then lastly, employers may face job losses or culture clashes, which is given with any M&A. So that's it. Thank y'all.
Good morning. We are here to present our findings as part of the case competition for the TCU NAPE. Case competition that we worked on yesterday. We're a team from the University of Texas. My name is Brett. This is Oskand, Umair, and Mike. Get our presentation started here. All right, so we just wanted to start off by going over the 4 key takeaways from our presentation just to set the groundwork there. So the first one we want to go over, just talking about the upstream consolidation. We believe that it's more than likely going to continue into the future, and that we believe that it will have a positive impact overall on the marketplace. Number 2 is that we think that there are multiple acquisition targets that are very attractive in the marketplace. We're going to touch on those, including doing a little bit of a deep dive into a potential merger of equals between Diamondback and Devon Energy. Number 3 is we're going to talk about how the trend of consolidation in the upstream space can help to unlock some of the energy transition with funding and other means. Go over that more in depth later on. And number 4, we're going to talk about our long-term view and the impact of this consolidation trend. Just to go through the agenda quickly, so we're going to just run through the current consolidation path for U.S. oil and gas in the upstream space. Then we're going to move on to trends in deal making, some potential M&A opportunities in the marketplace. We're going to touch on the impact of this consolidation on domestic supply growth. We're going to talk about the potential effect on consumers as a result of this oil and gas consolidation. We're also going to touch on the influence that results in the energy transition space, and then some of the derivative impacts on consolidation. All right, so we first wanted to start off by reviewing the question, is this the best outcome for shareholders of these companies? So we'll go over the pros and the cons and some of the first and second order effects as a result of this. So starting with the pros, first order effects as a result of this consolidation. You can recognize a lot of operational efficiencies, geographical synergies with properties that align very closely, and you can recognize cost synergies as well from combined operations. Another point is touching on the increased economies of scale for larger companies, which can be highly accretive to the free cash flow generated, which is very attractive for the investors. That free cash flow can be kicked back to them in the form of a dividend or share repurchases, which both is very beneficial to the shareholder in the short and long term. Also, the consolidation can help secure the long-term future by increasing the inventory and current production of these upstream companies, which guarantees a longer-term security of the share price and stability with that as well. Some of the second-order effects for pros as well is
talking about this can raise the other share prices of other companies as they make themselves more attractive for potential acquisitions, so increasing the equity value of these companies that otherwise wouldn't be at these elevated levels, beneficial to those shareholders as well. And then just a last second order effect is talking about the acreage price increases, which helps to drive up the underlying assets for some of these upstream companies. So we talked about some of the pros, let's focus on some of the cons as well. So some of the first order effects we're talking about is just that, with especially Exxon, Pioneer, Chevron, Hess, these larger upstream companies gaining even more power and presence in the marketplace, not only for production and controlling the supply that gets into the market, but also the impact that that has on price as well to consumers. Another con is touching on, the current trend of the past few years in the market is that a lot of companies have cut back on their exploration and drilling new wells. That's made it tough to get more supply into the market as companies have kind of waited to see what was going to happen with commodity prices. Another thing as well is that, a lot of times cost synergies are announced at the beginning of a transaction, but in order to realize those actual cost synergies, CapEx becomes sacrificed by a lot of these companies, and so they cut back on that, which can reduce innovation, reduce the exploration, and that's really a short-term strategy focused on the share price instead of a long-term growth or innovation strategy. Some of the second-order effects as well is that acreage prices and company prices can be driven up much higher than they should be based off of the underlying assets, which makes the M&A activity lower just because the values are higher than they really should be. The last one that we'll touch on here is that companies can be waiting in the short term for an acquisition instead of having a more long-term strategy. And so they're not really focused on improving operations, they're just waiting to try and go through a sale process. So here we're just going to touch on a potential transaction, get a little bit of detail on this. So one of our proposals is a merger of equals between Diamondback Energy and Devon Energy. Just some quick numbers to go over. The enterprise value and the market cap of these companies is very similar. Just to touch on kind of the operations and the net margins, Diamondback has 60% higher net margins than Devon Energy for the past 12 months, and they're currently projected to be 70% higher in the next 12 months. So really efficient operations, really strong profitability of that company. As a result, Diamondback has a higher EPS, both actual and next 12 months, as well as their PE, because the market's valuing their more efficient operations than Devon Energy. As a result of that, we think Diamondback should lead the merger of equals between the two companies. They have stronger operational efficiency and higher profitability. We think that there is a large potential for geographical and cost synergies from the combined acreage and operations in the Permian, specifically in the Delaware Subbasin. And we also think an important point is talking about consolidation in these mature, developed basins is really good for these companies that are highly experienced there. And then it also leads to short cycle barrels, so the joint company is able to throttle down and throttle up production more easily in the future to accommodate the commodity prices. So we also wanted to touch on some potential acquisition targets in the marketplace. So Endeavor Energy is one that recently announced they're exploring the possibility of a sale for $25 to $30 billion. They're currently the largest privately held oil producer in the Permian Basin. And they have 350,000 net acres in the Midland. So a highly attractive company, a strong track record of production. Just some other smaller companies to touch on as well. Vital Energy. So right now they've gone through, I think, 4 or 5 transactions in the past 4 months to acquire acreage in the Permian Basin, highly oil-weighted wells as well for inventory instead of as gassy, so higher value assets there. The transactions have had a huge impact on their free cash flow and made them a lot more attractive for acquisition. Another possibility is Permian Resources. They purchased Earthstone Energy in order to increase their Delaware presence. They optimized their portfolio earlier this year, divesting some acreage while acquiring others to get more geographical synergies and maximize profit. And Terra Resources, currently not integrated, but a purchase and integration of that could realize significant synergies. And then Marathon Oil is the last one we'll touch on here. Eagle Ford and Bakken heavy, which would be really attractive for a company that's heavy in the Haynesville or the Permian to diversify and increase their production across geographical areas.
Thanks, Brett. So next we looked at kind of how the consolidation is going to impact supply growth. We took a kind of neutral look to this, as we think some of the driving factors aren't necessarily being affected by the consolidation as these companies are preparing for kind of some future growth. So first, looking at policy and geopolitics, kind of government policy right now is very uncertain. Same with the geopolitical environment in the Middle East. So through the consolidation, companies can high-grade their reserves, increase production, and pursue operational efficiencies while taking a long-term approach to financial stability in times of regulatory and geopolitical uncertainty. Next, shareholders are looking to get their returns from their investments and kind of forcing companies to take a short-term approach instead of working towards future growth. The strategic consolidation allows for improvements in these operational efficiencies in order to boost their cash flows, improve margins, while providing production growth. Facing some economic headwinds going into 2024 and some uncertainty in the macroeconomic environment, the consolidation can provide access to low-cost inventory, which we have seen through Exxon Pioneer and Chevron Hess deals. And finally, innovation. Innovation can drive increases in supply, as we saw through the shale boom. And this can kind of work against consolidation, as larger companies tend to adopt more innovative techniques through acquisition of smaller companies. And these consolidations tend to kind of hamper competition, which kind of decreases innovation. Next slide. We did a little case study, kind of just looking at Exxon Pioneer merger and some of the supply pre and post acquisition. Some of the internal impacts of consolidation. Production budget is expected to decrease as a combined entity when compared to two separate entities. This could lead to a decrease in future exploration and development. However, the operational efficiencies can lead to improved output with less CapEx. So we're seeing a net neutral effect with this consolidation. And over on the right, we can see Pioneer increasing their production through their Guyana assets and continuing to add roughly 20% overall production through their Pioneer acquisition, but overall industry supply to remain relatively stable. Next slide. Then we looked at the impact of E&P consolidation on consumers. Again, we're not seeing a huge impact on consumers, but positively through energy security, consolidation can lead to more efficient production and improved margins, which enhances their ability to kind of withstand some of the price volatility that we're expecting kind of over the next kind of 24 months. Sorry, can you go back? We see an increased resource base and access to IP, which can drive innovation across the platforms. Pricing power, fewer number of competitors leads to more pricing power, which could negatively impact consumers. However, given the large number of current producers, roughly 9,000, representing 83% of U.S. supply, these mergers have relatively minimal impact on pricing power. Even looking at the Exxon Pioneer deal, combined, they have roughly 5% of U.S. production, which is relatively small in this fragmented market. Some of the ESG metrics, large public corporations often have more scrutiny regarding ESG standards and impacts. So these oil majors have been focused to increase on low carbon assets through acquisition. And that's what we're seeing through like Pioneer Exxon deal, kind of high grading their assets in the Permian that are relatively less carbon intensive. Next slide.
Thanks, Mike. So I'll be talking about the energy transition piece. This slide actually highlights the 4 challenges that the companies in the E&P space today face when it comes to energy transition. You have challenges across the financial capital, you have challenges across human capital, you have challenges across transparency, and lastly, the influence piece. In terms of financial capital, a lot of this energy transition piece requires outlay of capital, and you're talking about significant capital outlay that requires robust balance sheets. A consolidation play in this space would really enhance the company's balance sheets and would result in acceleration towards energy transition. You can look at Exxon's, let's say, 2030 reduction targets across methane. You won't find that in a pure play E&P company. When it comes to access to human capital, a lot of the business model in the transition space are not directly in line with what E&P companies do today. And that requires upskilling in terms of what they need to understand, and that also requires a lot of innovation. If you look at a consolidated entity or a bigger oil and gas company like Chevron or BP, BP is trying to get into power generation. Chevron is trying to get into biofuels. Both of these business models are not something that a pure play upstream E&P company would do today. I think Mike kind of touched upon the transparency piece, so I'll leave that, but I'll talk a little bit about the influence piece. None of the smaller E&P companies have a seat at the table. They don't dictate policy. They don't have a voice in the game. If you look at the biggest energy transition conference that happens, COP28, none of these guys were invited. However, all the majors or most of the majors were invited. So that kind of tells you the political influence that a consolidated entity holds over a standalone entity. And now this slide kind of talks about the array of opportunities that you have in the energy transition piece. We've clubbed these opportunities across 4 buckets: the molecule piece, the electrification piece, the circular economy piece, and the sequestration piece. Within molecules, we have biofuels. Think about renewable diesel, sustainable aviation fuel, hydrogen, and lithium. Within electrification, you have renewable power, so on-site power generation from solar, wind, battery. You also have business models in the energy electric vehicle value chain. When it comes to circular plastic, you have water and plastic, and sequestration is carbon capture and storage. Across all of these categories, we've highlighted deals that have happened in the recent past, or we've highlighted targets that some of these majors have put out for 2030. These are all significant numbers we're talking about, but I think for the sake of time, I'll just move on.
Yep, thank you, Umer. So now we are going to look at some of the factors which are getting influenced by consolidation. These are auxiliary factors, but are also significantly important. Now, first it comes to employment. Now, with consolidation, definitely there are going to be job cuts, but in the long term, you see the mega companies would definitely go after the hydrogen project or a carbon capture project, so it again opens a different stream for employment. Again, if you look at innovation, now if you look at the fracking story in US, it was the independents who actually went after fracking and eventually succeeded. It was after the independents succeeded that the likes of Chevron, Exxon came back and were focusing on the Permian assets. So we believe that with consolidation, there is a risk that we might struggle with innovation in the oil and gas space. But again, there is a different point of view that these big companies would have significant higher budgets to actually focus on developing new technologies. With efficiency, there would be an impact. Now, we have already spoken about scale of operations and driving synergy. So operationally, we are going to see a higher efficiency. But when it comes to facing bureaucratic challenges within the organization, as the consolidation happens, big companies emerge, so there are going to be a lot of challenges to get approvals within the organization. So moving on to the next slide. Now, if we look at the OFS or the service provider, which are actually the backbone for the upstream oil and gas industry, OFS are also going to face a lot of challenges where they have now to deal with the fewer customers, which again puts the pricing power with the customer. It will squeeze their margins, and their contracts are already, they're not making a lot of profit, and with less capital to hand, they'll further stifle innovation even in the OFS space. But it also gives an opportunity for the OFS to consolidate amongst themselves, provide services at a lower cost, and have a stable relationship with the E&P providers. There are other risks and opportunities too. But overall, I would like to highlight that, of course, we are going to a new paradigm shift in the upstream oil and gas industry, and this gives an opportunity for everyone, the employers, employees, the universities to reevaluate their training module, the employers to look at upskilling themselves, and this could actually lead on to greater success over the long term. So thank you. Thank you for those opportunities.